On October 6, 2021, a single bet placed through DraftKings cost the company $1.2 million. The wager was simple: Michigan State to beat Western Kentucky in college football. The stake was modest, just $25. But when Michigan State won 48-31, the bettor collected a payout that should have been mathematically impossible. The error wasn't in the game. It was in the code. DraftKings had accidentally offered odds of 50,000 to 1 on what should have been a routine victory. Within minutes, sharp bettors across the country had spotted the glitch and hammered the line. The sportsbook honored every bet, writing checks that turned a promotional mishap into $1 million lesson about the razor-thin margins between profit and catastrophe in America's newest gold rush. This is another video where money, power, and history collide, and nothing is ever as simple as it looks. The story we tell ourselves about sports betting is clean and simple. Consenting adults make informed wagers on athletic contests. Technology democratizes access to betting markets once controlled by shadowy bookmakers. State governments collect tax revenue from an activity that was happening illegally anyway. Everyone wins except the occasional degenerate gambler, and that's a personal choice, not a systemic problem. The numbers seem to support this narrative. Since the Supreme Court struck down the federal sports betting ban in 2018, legal wagering has exploded from zero to over $100 billion annually. 38 states have legalized some form of sports betting. Companies like FanDuel and DraftKings went from fantasy sports startups to publicly traded giants worth tens of billions of dollars. Major sports leagues, once opposed to gambling, now embrace official partnerships with sportsbooks. The NFL features betting odds during broadcasts. NBA arenas display live lines on scoreboards. The transformation appears complete and inevitable. America simply recognized what the rest of the world already knew. Sports betting is entertainment, not vice. The reality operates through a more sophisticated mechanism. Modern sports betting doesn't resemble the stereotype of bookmakers taking action in back rooms. It functions as a highly automated financial market where algorithms set prices, artificial intelligence identifies profitable customers, and data flows worth millions of dollars change hands in milliseconds. The process begins with odds compilation. Sportsbooks don't employ handicappers who watch game film and study injury reports. They purchase data feeds from companies like Kambi and SB Tech that use machine learning models to set opening lines across thousands of betting markets. These algorithms process everything from weather forecasts to social media sentiment to generate prices that update in real time. The real money comes from market making, not gambling. Professional sportsbooks operate like financial exchanges, matching bets between customers while taking a commission called the vig. They don't want to predict winners and losers. They want balanced action on both sides of every wager, guaranteeing profit regardless of outcomes. This creates an arms race for customer intelligence. Every click, every bet, every deposit and withdrawal feeds into models that classify users into precise categories. Recreational bettors who lose money consistently receive VIP treatment. Bonus offers, free bets, dedicated customer service representatives. Sharp bettors who show long-term profit get limited to tiny stakes or banned entirely. The goal is maximizing revenue per customer while minimizing risk from skilled players. The most profitable customers aren't the biggest bettors. They're the most predictable losers. Industry insiders call them red fish because they swim into nets willingly and repeatedly. These customers generate lifetime values measured in thousands of dollars through small, frequent losses that feel like entertainment expenses rather than gambling debts. Banks and payment processors play a crucial role in this ecosystem. Credit card companies initially blocked gambling transactions, but relaxed restrictions as states legalized sports betting. This created new revenue streams from transaction fees, while shifting responsibility for problem gambling from financial institutions to consumers. PayPal, Apple Pay, and Venmo integrated with betting apps, making deposits as seamless as ordering coffee. The regulatory framework amplifies rather than restrains these dynamics. State gambling commissions focus on tax collection and license compliance, not consumer protection. Advertising restrictions remain minimal compared to other potentially harmful products. Marketing budgets that would embarrass pharmaceutical companies flood sports broadcasts with promises of easy money and risk-free promotions. The system broke down precisely where economic theory predicted it would, at the intersection of technology, psychology, and regulation. Mobile betting apps use the same behavioral design principles as social media platforms and video games to maximize engagement. Push notifications arrived during live games. In-game betting allowed continuous wagering throughout athletic contests. Parlay builders encouraged exotic multi-team bets with terrible odds, but exciting payoff potential. Problem gambling rates exploded. States that legalized mobile sports betting saw increases in gambling addiction treatment requests of 30 to 40% within 2 years. Young men between 18 and 35 showed the highest rates of problematic behavior, often betting money they couldn't afford to lose on outcomes they couldn't predict or control. The most revealing collapse came through the data itself. Academic researchers gained access to anonymized betting records from European sportsbooks and discovered that 5% of customers generated 50% of total revenue. These heavy users showed patterns consistent with addiction: chasing losses with bigger bets, gambling on unfamiliar sports, ignoring bankroll management principles. The business model depended on cultivating and exploiting compulsive behavior, not providing entertainment to casual fans. Credit counselors reported new categories of debt tied to sports betting. Unlike casino gambling, which required physical presence and cash transactions, mobile betting integrated seamlessly into daily life. Customers could lose thousands of dollars during lunch breaks without leaving their offices. Payroll advances, credit card cash advances, and peer-to-peer payment apps provided instant funding for betting accounts. The promotional economy created particularly perverse incentives. Sportsbooks offered new customers hundreds of dollars in bonus bets, then designed terms and conditions that made withdrawing winnings nearly impossible without substantial additional wagering. Risk-free bet promotions refunded losing wagers with site credits that expired quickly, encouraging immediate reinvestment rather than withdrawal. Professional sports leagues found themselves compromised by gambling revenue they had initially resisted. Referees faced new scrutiny over calls that affected betting outcomes. Players received education about points-having schemes, while their employers promoted partnerships with companies that profited from those same point spreads. The integrity of competition became secondary to the entertainment value of wagering opportunities. The names have changed, but the behavior mirrors every speculative bubble in financial history. Dot-com stocks promised democratized investing through technology. Subprime mortgages offered homeownership to previously excluded borrowers. Cryptocurrency created new asset classes free from traditional banking constraints. Each innovation claimed to eliminate old problems through better information, broader access, and smarter regulation. Sports betting follows the same pattern. Technology doesn't eliminate the house edge, it makes the house edge invisible. Mobile apps don't democratize gambling, they industrialize addiction. State regulation doesn't protect consumers, it legitimizes exploitation through official oversight. Modern parallels extend beyond gambling into the broader attention economy. Social media platforms use variable reward schedules identical to slot machines. Video games monetize through loot boxes that function as digital scratch tickets. Investment apps gamify stock, trading with confetti animations and achievement badges. The psychological mechanisms that drive problematic gambling now shape multiple industries worth hundreds of billions of dollars. The regulatory response remains fragmented and reactive. Some states imposed deposit limits and cooling-off periods after recognizing problem gambling increases. Others doubled down on expansion, legalizing online casino games and poker to maximize tax revenue. Federal coordination appears unlikely as states compete for gambling industry investment and jobs. The philosophical questions cut deeper than regulatory solutions. Sports betting represents the financialization of leisure, turning entertainment into asset prices that fluctuate based on human performance. Athletic contests become vehicles for wealth transfer rather than cultural experiences. The outcome matters less than the economic opportunity it creates for sophisticated market makers. The billion-dollar fleecing wasn't a crime or conspiracy. It was the predictable result of applying financial engineering to human psychology. The victims weren't cheated. They were precisely served what they thought they wanted. The house always wins, but now the house is publicly traded and the game never closes. Money doesn't corrupt institutions. It reveals what they were always willing to become when the price was right.